Over the last few years, retail trading has started to look a lot less like a financial market and a lot more like a video game. Step inside this highly saturated ecosystem, and you'll quickly find yourself in what traders call the option zoo. It's a culture where standard financial transactions are heavily dressed up with exotic, animal-based names. You'll hear people enthusiastically talking about executing Jade Lizards, setting up iron condors, and trading broken-wing butterflies. For a new trader, executing a strategy with a name like that feels sophisticated. It suggests they've moved past basic stocks and are now operating with the specialized tools of a high-level professional. This naming convention creates an environment where complexity is equated with expertise. But it raises a question. Are these exotic names describing a new discovery, or are they simply creating an illusion of sophistication? Options expert Heather Cullen points out that there are actually very few truly new discoveries in this space. Strip away the branding, and these exotic animals are simply combinations of buying and selling calls and puts. The industry realized pitching a short put with a call spread sounded boring, so they gave it a mascot. Which leads to the real problem. If the option zoo is just repackaged basic selling, what mathematical risks are hiding behind the catchy marketing? Take a look at a strategy known as the wheel. It is heavily promoted online as a logical, comforting, and virtually foolproof way to generate steady passive income. The mechanics seem straightforward. You sell put options on a stock you'd like to own, collect the premium, and then sell covered calls against those shares once you have them in your account. What the marketing materials often leave out is that this cycle forces you to strictly cap your upside. If the stock takes off in a massive run, your profits hit a predetermined ceiling. Conversely, if the market turns, you are completely exposed. The strategy leaves you holding a bag of collapsing shares as the bottom falls out. For the psychological comfort of pocketing tiny, frequent cash premiums, traders using the wheel systematically sacrifice their actual market participation while taking on hidden tail risks. To test the reality of this safe income narrative, Cullen tracked the exact math from one of her own real-world trades using the S&P 500 and the NASDAQ. She sold 3 contracts each of SPY and QQQ. To secure those specific positions, she had to lock up over $435,000 in cash, and for risking nearly $500,000 of capital, she collected a premium of exactly $1,191, a microscopic return of 0.27%. But the real pain comes from what she missed. Because the broader market surged during that exact period, her capped upside meant she gave up over $13,000 in total capital gains. When you lay the math bare, you realize that giving up $13,000 to collect $1,000 is a remarkably expensive way to generate yield. It actively destroys the long-term power of compounding. To understand why retail traders accept such poor math, we have to look at how the options market evolved to this point. Originally, back in the 1970s and 80s, options were largely the domain of professionals. Institutions used straddles and spreads primarily for dry, unglamorous tasks like managing inventory and hedging portfolio risk. Fast forward to the 2010s, and the culture shifted. YouTube influencers and gamified brokerage apps flooded the internet, promising massive windfalls to everyday retail traders. But when those giant payouts proved mathematically impossible for the average person to sustain, the industry needed a new pitch. They pivoted heavily, selling the idea of income generation and theta to keep users engaged. The modern retail ecosystem intentionally sidelined the old-fashioned goal of long-term capital growth. Instead, it trained an entire generation to constantly monitor their screens just to harvest tiny bits of market noise. Cullen prefers an alternative path, the in-the-money, or ITM strategy. The ITM approach strips away the complexity completely. It ignores the constant, active management of premium selling, focusing instead entirely on trend, leverage, and capturing major market moves. True wealth creation relies on stepping out of the day-to-day noise and allowing long-term compounding to do the heavy lifting. Over the last decade, as options trading exploded into the mainstream, the names of the strategies certainly got a lot more exotic. The underlying returns did not.